Welcome to Accounting 101. Dr. Donna Bryce here. This is part two of our journal entry lecture. And what we discussed last week was understanding the fundamentals of why journal entry is so important in accounting. As we discussed last week, with the journal entry, it impacts at least two different parts when it comes on to any transactions that we have. It goes back to also the matching principles from when we discussed GAAP, which says that for every debit there must be a corresponding or matching credit. For every yin there must be a yang. But before we get into deep analysis of journal entries, which is so important to accounting and will be on your midterm for next week, I want to also have you understand what is assets, what are liabilities, and how they differ, and specific examples of them. So we mentioned last week, which is just a quick refresher of what we did, examples of assets. Since these are things that you own, it could be cash, could be a great example of it. We discussed accounts receivable, and what accounts receivable are basically a fancy term for an IOU. You've done the work, you haven't just had the money in hand yet. So you've written me an IOU, so on your end you're expecting money to come in. Supplies, anything that you've prepaid, that is also an asset. Now in regards to long-term assets, the big one, things that you own, would be land, your car, property, equipments. All of those are examples of long-term assets, which are still assets, things that you own. Now, in regards to liability, we said liabilities are things that you owe. So think about it, anything that is payable, meaning that you now have an IOU. You owe somebody something. So notes payable, loans payable, taxes payable, wages payable. So if you're an employer and you've hired someone and they've done the work and you haven't done payroll as yet, on your end, that is wages payable for them. And on the employee's end, they are expecting it. So that would be a debit on the employee's end, or that would actually be an asset because they're expecting it coming in, which that is actually a great segue into journal entries, seeing that for journal entries, it impacts at least two different transactions. So let's actually take out accounting again and wake up your brain. What we would think. Let's say you're going to walk into the deli and you're going to buy a bottle of water. The bottle of water is $1. What happens? You give the deli man the dollar and he gives you what? The bottle of water. So two things happen. What? Your money, your cash went down, but your supplies went up. On the deli man's point of view, their supplies went down, but their cash went up, right? And that is what journal entry is, meaning that there's always at least two sides that are impacted. Now, I mentioned last week that when you get into the midterm or any accounting class, here's one of the tips that you should do when it comes on to journal entry. You write debit the receiver, credit the giver. So with every transaction, you want to sit and say what is coming in, and what is coming in is usually going on the debit side, and what is going out goes on the credit side. So you debit the receiver and you credit the giver. So let's go back now to that deli man. Let's say we are the deli. We own the deli, right? And we said that someone walked in, right? And they bought a bottle of water. So from the deli man's point of view, what would be the journal entry? Debit the receiver, credit the giver. So for the journal entry, right, which would be a T format. Some people can use the T format, or as last week as we mentioned, the L format, right? So let's say the deli, right? So what would we debit? What is coming in? Our customer is giving us cash, right? So debit cash for how much? $1, right? And credit what? What just went out? Supplies, bottle of water. So supplies. So supplies, you get credit $1. So we've done two things, right? We've done a journal entry. We have two sides, but the only thing that is important for accounting is the most important thing some people might think for journal entries is what? The date. Because let's say you only put this in, and when you have to do your books at the end of the year, we don't see the date on it. You can't keep track of what is going on. So as we've mentioned, the most important thing is you want to put the date on it. So let's say it was September 13th, right? And we know it's the year, so we put September 13th, and this can tell us that we had an increase in cash by $1, and it's because our supplies went down by $1. All right, so let's try another example, right? So we're starting really simply because I want you to get the concept of what it is. So let's say someone walked in and we still own the deli, and they buy, I don't know, a ham sandwich, right? They did food, they bought a ham sandwich, but they paid with their ATM card. So we won't put ATM card because that would be bank. So it goes in directly into our bank. That's what the ATM card does, right? So remember, we debit the receiver, we credit the giver. Now what came in? Bank, money, not cash, because I didn't physically get the cash in my hand. So it's bank, it's called bank in accounting term. So bank, and then what went out? My ham sandwich. What date it happened? Let's say it happened September 20th. So what would be the entry? September 20th, 9/20, bank as opposed to cash, because we debit the receiver, so I received the bank. So it is bank. How much was the ham sandwich? Did I tell you how much the ham sandwich is? How much is the ham sandwich? I don't know how much is. Let's say it's $5. $5, right? And supplies, $5, right? So we debit the receiver, we credit the giver, and we went through it. We have the date, we have what happened, we debit the receiver, and we credit the giver. Okay, so you're ready to do some more journal entries? Okay, so here's one. Try this one. So I guess we still own the deli, right? So let's say on September 25th, we purchased a machine for $500 cash. So we own the deli and we purchased a machine for $500 cash on September 25th. So let me write this down. So 9/25, we purchased the machine for $500 cash. We debit the receiver. What are we receiving? We're receiving the machine. And what are we giving out? What is walking out the door? Cash. So we debit the receiver. So on September 25th, it would be machine or machinery, $500. And what do we credit? Cash. $500. Make sense? So we debit the receiver and we credit the giver. All right? We still own the deli. Okay? Now let's say September 26th, we pay our utility bill through our bank account for $100, right? So September 26th, 9/26, we paid our utility bill through the bank account, through our business bank account for $100. So what is coming in? You're like, Dr. Boyce, nothing is coming in. All right, if you don't understand what is coming in, let's jump to what is coming out. But we need two we need two entries. What is going out? I know I'm paying. So if something is paying out, we know that cash is walking out or bank is walking out. We know that money is going down. So is bank or cash going on the debit side? No. So on the credit side, we said it was through the company's bank account. So we're putting bank for $100. And here's a good thing about accounting. Since we say that for every debit there must be a credit, for every credit there must be a debit, we know that bank is on the credit side because money is walking out of our business. Now we need to know what is going on the debit side. And it's an expense. And expenses, all expenses must be debited. And so we are paying a utility bill. So even if you didn't even understand, wait, where debit the receiver, credit the giver, I didn't receive anything. Even if you can't conceptually understand this, jump to the giver part. And what is the giver? Money just walked out of my account. So we credit bank. This is an expense. All expenses must be debited. So we put utility. Hopefully that makes sense. So always sit down, debit the receiver, credit the giver. Even if you don't understand what is the receiver, jump to the giver portion. Even if you don't understand what is the giver, jump to the receiver portion. That way you can figure out at least the correct side of one side of it. Then you know with the matching principle, for every debit there must be a credit. For every credit you must have a debit. Does that make sense? All right, so on 9/26 we paid the utility bill for $100 through the bank, through the business's account, right? Now, here's a crazy one. Let's say on 9/27 we received interest, like $5, because the bank ain't giving us much money. We received interest from our bank account, right? We received $5 interest. We checked our bank account and we saw that there's a $5 interest that we have. Now, how would you journalize this? So let's say on 9/27. So on 9/27, we receive what is coming in. We're getting extra cash, right? I don't know what's going on the credit side, but let's do one side or the other. We know the date, and we received interest on our bank account, so our money is going up. And once our money is going up, once our cash or our bank is going up, we debit the receiver, so we're receiving money. So it would be bank, right? $5. All right, let's figure out what goes on the credit side. What would go on the credit side? It would be finance income, because it's an income, something on the credit side that would be some form of revenue, and all revenues should be credited. All right, so you would be finance income, $5. All right, we're chugging along. Does that make sense? Debit the receiver, credit the giver. Here is one now, and this will be on your midterm and it will be on your finals. Let's say on September 28th, listen to me, you walked into the bank and you applied for a loan. You walked into the bank and you applied for a loan for $10,000. What do you think the journal entry is? And you can tell on my face. You walked into the bank on September 28th and you applied for a $10,000 loan. Any takers? Here's the thing. It would be, ready? 9/28, no entry. Wait, what is no entry? You applied for the loan. Did you get anything? Did you give anything? Did I tell you the loan was approved? No entry. So you have certain things when you're doing journal entries are just informational. So that would be an example of it. That, okay, you applied for a loan. It didn't tell me that you got the loan. It didn't tell me that your loan was denied. It didn't tell me anything other than you applied for a loan. So that would be just a no entry. Another example of what be a no entry, you're starting a business and you hired two individuals to start working day one, but to be paid at the end of the month. Okay, until you say I paid the employees or something, that's just an information. If I tell you you walked into the bank and you picked up the bank slip and you filled out the bank slip for $500, okay, that's good. So sometimes you have to stop, you have to think about it and say, was this a transaction? And was it a transaction that impacts anything? So me applying for a bank loan is a no entry because I didn't get any money. There was no receiver to receive and there was no giver to give. Okay? Does that make sense? So make sure you understand there will be little tips and tricks that are on there. All right? So what I would recommend you do in addition to what we discussed last week is on your own to actually look at other journal entries and see if you can do them. And if there are any ones that are tripping you up, take a breath, look at it and be like, okay, what am I supposed to do? Debit the receiver. What is coming in? I don't know what's coming in. I'm confused in what's coming in. Still take a breath. Credit the giver. What is going out? Usually something is going out. You can figure out what is going out, or you can figure out what's coming in, or you can figure out both. Now, if you can't figure out what's going out, what is coming in, or either one of them, is it an expense? What type of things are those? All expenses should be debited. All revenues should be credited. What is it? Is it an asset? Is it increasing my asset? Assets can be tangible or intangible. Assets are things that I own. I have current asset and I have long-term asset. Is it an asset? Is it not an asset? Is it a liability? Liabilities are things I owe. I have a long-term liability and I also can have current liability. What exactly is it? And if all of that still doesn't make sense, take accounting out of it, which usually that's how you should start about it, and say, okay, conceptually, what is going on? A perfect example would be the 928 entry here. I applied for a bank loan for $10,000. It didn't increase my money. It didn't decrease my money. Nothing else happened than I applied for a loan. So that is a no entry on my end. So think of it conceptually first. Do you think that it makes or impact anything? And once you realize if it did, what is it? Credit? Is it credit? Is it going on the credit side? Is it going on the debit side? Is it a receiver? Is it a giver? Is it an asset? Is it a liability? Is it a revenue? Is it an expenditure? What is it? And then you sit and you try and you put it on whether the debit side or the credit side. Now, I can tell you for your midterm next week how you can lose points if you don't have the dates. You're going to automatically lose points. If you put a debit and not a credit, you're going to lose a lot of points because that's just going to make me angry. So per the matching principle and for what I've already told you multiple times, for every debit you must have a credit. For every credit you must have a debit. So even if you figure out the debit and you can't figure out the credit, figure something out and put in the credit, because if you only give me a debit without a credit, it's wrong. And if you give me a credit without a debit, it's wrong. So therefore, you have to always know that the matching principle should be in existence. Now, here's an example. You should at least have two. Can you have more than two entries for one transactions? Absolutely. Here's an example. On September 29th, a customer walked into our deli and they bought stuff that came up to they bought supplies that came up to $13. They spent $3 worth of cash. They paid $3 worth in cash and $10 through bank. So 9.29. What came in? Cash came in at $3. Bank came in at what? $10. But my overall supplies went down by what? 13. So even though I had 2 debits, 1 credit, the total matched. Make sense? All right. So you have to do some independent work on journal entries. But if you have any real concerns in regards to Dr. Boris, this is stripping me up, by all means, reach out via email or through Blackboard. But please make sure you do your work on journal entries. Even though it's open book, it is impossible to pass the midterm and or the finals without having a good understanding of journal entries, okay? Happy reading.